All right. Well, let's see. Let's talk about credit scores and home buying mistakes.
Okay.
One of the most common questions out there: what credit score do buyers need to qualify for the best rates today?
Good question. And of course, it varies depending on loan type. Um, the standard, kind of mortgage product we talk about all the time, of course, is that conforming conventional loan. In Riverside County, the maximum is 806 500. These are loans that generally are going to get sold to Fannie Mae or Freddie Mac. Those two agencies have a credit score grid that is published that determines how a mortgage is going to be what I call priced, which basically means what effect on the price, the rate, and the discount cost, if any, is going to be applied toward that loan based on credit score. So their grid is in tiers, 20-point tiers. So the top tier is 780. So if you're going to get a conventional conforming Fannie Mae Freddie Mac loan, you want to be 780 or better on your score. That will get you the best rate. Now, again, keep in mind when we say 780, if it's one borrower, that's their middle score of the three bureaus, Equifax, Experian, TransUnion. If it's two people or a married couple, it's the lowest middle of the two people. So that is how, the score that's used for getting the best rate. Now, what happens is, as I said, the Fannie Freddie grid goes down in 20-point increments. So your second best tier is 760 to 779. Then your third best tier is 740 to 759. And your fourth best, 720 to 739 and so forth, all the way down to 620. So, and when you get further down on that schedule, down to 620 to 639, the adjustment or the hit to the price of the loan is pretty hard. It's going to probably mean you're going to look at a rate that's going to be somewhere in the range of probably at least a half to maybe as much as 0.75% higher than if you're at 780.
Oh,
Now, in FHA, VA, USDA, I would say generally you're going to get the best price or best rate if you're in the 720 to 740 or better. So you don't have to be as high as 780 to get the best rate. The other thing about those three agencies, again, those are direct federal agencies where they insure or guarantee the loan. The tiers for lower scores are much wider, much, I say, kinder or much friendlier. So you don't have as much of a price hit, as we call it, for a borrower who isn't at 740. If they're at 610, they're going to pay a higher rate, but the extent of that higher rate is much more muted than if it's a conventional loan. That's why I always say, if you're going to put 5% down on a conventional loan, or you've been told to do that, and your credit score is 628, I will urge you darn well better be looking at an FHA option as well, because what you're going to find is you're going to be much better off on rate and therefore payment if you're on that lower credit score level to go with an FHA loan. Do not go with a conventional loan. You're going to be paying a lot more in terms of monthly payment. So that's, and then on jumbos, finally, I'll comment on those real quickly. For a jumbo loan, again, same thing. You basically, for best rate, in some cases, you have to be as high as 800 or higher. Most are going to be somewhere in the 760 or 780 plus. And with jumbo loans, you don't get to go nearly as deep down on the credit score range. Most jumbo programs kind of stop or aren't available if you get below, say, 660. Then at that point, jumbo loans get pretty hard to find.
and jumbo loans are just simply above the allowable. What you tell me? Jumbo loan is an amount that you're borrowing above a certain amount.
Yeah, the jumbo loans, broadly speaking, is any loan amount that's higher than the conforming conventional limit each year. So the national conforming conventional limit is 806 500. Now, in some areas, what we call high cost areas, typically by county, there is a secondary category called agency high balance, where you can get, like, not in Riverside County, we don't have an agency high balance because of our price level. But in LA County or Orange County or San Diego County or up in Northern California, if you're in Santa Clara County, you're going to have a second category for Fannie Mae Freddie Mac loans called agency high balance that will go even higher. So the point is, a traditional jumbo loan in Riverside County is going to be any loan that's 806-501. That's a jumbo loan. Whereas in Orange County, the traditional official jumbo loan would be $1 over the agency high balance limit, which is like somewhere around $1.1 million or $2 million. So that's basically the difference between jumbo and then conventional or FHA-VA.
We have one question that came in from one of our viewers that I want to share. It says, there's a lot of advice floating around, like don't buy a car, don't open a new credit card while buying a home. Can you confirm what's true and what's just mortgage myth?
Actually, that's not a myth. That's generally true. I mean, the idea here is that, and this is true whether you're refinancing a home that you already own or you're looking to buy and you're opening an escrow. We do urge people, try to be careful about incurring new debt. One of the things folks don't realize, and they've in a few cases they've found out the hard way. When we start the process and we pre-qualify, of course, part of what we're going to do is pull your credit. Well, some folks may think that when we do that, okay, it's over. They've got my credit report. I don't need to worry about anything, and I can just do what I please. I'm going to go shop for a car this weekend, and I don't think it's none of their business. I'm just going to go do it. Well, that's a problem, because especially if, again, we've got an open escrow on a purchase, or we've started a refi, we open an escrow for that. The loan's in process. It's registered with the lender. It's going to be underwritten. The lender is going to continue what we call basically credit backup monitoring. So throughout the open period of processing either that refinance loan or that purchase loan, up until it's closed and funded, the lender is going to be in the background monitoring your credit. So if you apply for a new credit card, you're out shopping this weekend and 6 different car dealerships are pulled your credit, they're going to know, and we're going to get contacted, and we're going to have to find out why that occurred, find out if you open a new loan, and get documentation for that new loan. And then we have to determine if that's going to affect your, otherwise, you've been pre-approved perhaps, find out if that's going to affect your ability to qualify once we discover that new debt that wasn't disclosed.
So then the answer is, hey, once you start that refinance or a purchase, just kind of put things on chill until after the loan is closed.
Basically, yes, but if you feel compelled that you have to make a purchase decision of some sort, maybe a major one, a lot of times it has to do with, I want to go buy appliances because it's this weekend only, some sale for the house I'm in escrow to buy. Can I go buy those appliances because we haven't closed yet? Best thing to do, check with us if we're handling your loan, check with whoever is handling your loan, find out what you intend to do, let them know, and they can crunch some numbers and tell you if you should or if you should hold off.
One other piece to this is there a difference if I were going to go, let's say, buy a car versus, I'm going to lease a car? Does that show up any differently, Art?
No. No, in fact, a car loan payment or a car lease payment have the same effect on your qualifying debt ratio. The one thing I would tell anybody who already has a car financed, and if you're looking to apply for a loan, one benefit of owning a car with a car loan versus leasing. If your car loan at the time you've applied for a mortgage, based on the monthly payment for that car loan, is going to be paid off in 10 months or less, we can ignore that car loan payment in qualifying and calculating your debt ratio. If you have a car lease and your car lease balance is 9 months to go based on your lease payment, we still have to count it. And the reason is, with the lease, if you think about it, logical, it's a lease. What you're paying doesn't, at the end of the lease term, doesn't mean you've paid enough to outright own the car. So you will have to either turn in the car, which means you'll probably have to get another car and incur a new payment, or if you want to keep the car, not have a payment, you'd have to find funds elsewhere and pay off the lease balance, the residual value balance, so you own it outright. So for those reasons, even if you only have 2, 3, 6, 7, 8 months to go on a car lease, we still have to count it.